UiPath recently told its investors that its growth rate was slowing dramatically. That news caused its stock to crash and it even hit an all-time low. While UiPath's growth rate is slowing, we actually think that there are reasons that this is a net positive for shareholders in the long run. How can that be? We'll explain everything next. My name is Brian Feroldi.
And my name is Brian Stoffel.
This video is sponsored by our friends at YCharts. More on them later.
Brian, it's important to remind folks what it is that UiPath does. It is a specialist in robotic process automation. In other words, the company's software allows repetitive tasks to be done by a computer.
We've made a handful of videos on UiPath, including a recent one where we covered what happens in the company's fourth quarter of 2021 earnings.
And what did we find out? It was a great quarter.
Yeah, Brian, the company's trailing numbers were excellent. Total customer count grew 28% to more than 10,100. The number of customers spending at least $100,000 each year grew 49% to almost 1,500. And the number of customers that are going to spend $1 million per year grew 78% to 158. This is a company that is thriving.
If we look at UiPath's top line, revenue grew 39% compared with the same time last year, a very solid mark.
Better yet, annualized recurring revenue grew 59%, which is a strong sign for future demand.
And perhaps our favorite metric when it comes to companies like this, UiPath's dollar-based net revenue retention rate was 145%. Not only did it hold on to its customers, but on average, got to get them to spend 45% more.
So if the trailing numbers were great, why did the stock plunge? In a word, it comes down to guidance. For the upcoming quarter, management told investors it only expects $223 to $225 million in revenue. By contrast, Wall Street was expecting more than $247 million. That's a huge difference.
Now let's put this in perspective. That means that UiPath is saying their revenue is going to decrease by 23% moving from the fourth quarter of 2021 to the current quarter in 2022. That's a huge slowdown because going from the third to the fourth quarter last year, revenue actually increased 31%.
The full year numbers were just as ugly. Management expects about $1.08 billion in revenue for the year. That's far below the $1.2 billion that Wall Street was expecting.
So, why is this happening to UiPath? Well, management offered up three big reasons.
First is the war that's going on between Russia and Ukraine. Management said that about 30% of its total revenue comes from Europe. And in Russia, the company expects a $15 million reduction in annualized recurring revenue this year due to the war.
The second big reason has to do with foreign exchange rates, which incidentally are largely impacted by what's going on in Russia and Ukraine as well.
UiPath sells its products in local currencies. So when the US dollar strengthens versus foreign currencies, that lowers their reported revenue. Management noted that currency movements are expected to take about $5 to $10 million in annualized recurring revenue in the first quarter and about $20 to $25 million for the full year. That's a bigger hit than the Russia and Ukrainian war.
And while both of those are certainly important, the third reason is the one that we want to focus on for this video, and that is that UiPath is transitioning its customers from an on-premise license model to a software as a service model.
Management noted that they expect this to be a big net positive in the long term. However, it's going to be a 4% headwind to revenue in the short term. That's a hit of about $40 to $50 million.
So before we get into this transition, let's just review to make sure we understand what exactly is happening. In the past, most UiPath customers would purchase a license and they would install UiPath software on-premise on their servers.
However, UiPath has since been transitioning its customers away from a licensing model towards a software as a service model.
So why would a company choose to do this? Well, we can think of three big reasons. One is that it widens the moat around UiPath. Because this is a recurring contract that's paid every year, switching costs become higher. There's not a date where a customer can choose to switch to someone else. Second, it lowers the cost to entry. It's better for customers. It's cheaper to get started on UiPath. And third, and probably often overlooked, is the fact that when UiPath can monitor how its tools are being used, it can create more tools for its customers, meaning that it has more optionality. This is a great long-term move for UiPath.
While all of those things are a net positive, this has a negative impact in the short term. Here's why. Let's say UiPath was about to do a deal that was worth $6,000. Under the licensing model, the company records $4,000 in the first year and about $1,000 each year thereafter in subscription revenue.
However, if they choose the SaaS model, they're paying the same amount over those 3 years, but it's much flatter at $2,000 per year.
So, under the licensing model, UiPath gets to record $4,000 in year one and $1,000 in year two and three.
But under the SaaS model, they only get to record $2,000 in revenue during year one. That looks a lot worse than under the licensing model.
Hence, the better the software as a service product does, the lower the company's revenue growth rate is this year.
Now, none of this would matter if UiPath couldn't hold on to its customers, but looking at its conference call, they revealed that not only do they have a net revenue retention of 145%, but a gross retention rate of 98%. That means of all the customers UI had at the beginning of the year, 98% were still on board at the end of the year.
That's an exceptionally high number. So, overall, the transition is a good thing and a net positive for investors. However, if you dig into their quarterly results, you'll see that licensing revenue currently accounts for about 60% of total revenue. So, as the company transitions its customers away from a licensing model, that has a serious negative impact on this year's revenue. Now, why would the company take on that short term pain, and why do we think that's a good thing? We'll show you a couple examples of how this move really paid off in the past. Before we do so, we want to give a shout out to this video's sponsor, which is YCharts. So if you've been following our channel for any period of time, you know that we're constantly using YCharts to make complex analysis more visual, intuitive, and shareable. Brian and I have used YCharts for years to do fundamental stock research, but the platform is actually far more powerful than that. It can be used to compare stocks, mutual funds, and ETFs on nearly any metric that you can think of. Paid users can also easily add their own logo to make it easy to distribute via email, blog, newsletter, or on social media. If you're interested in giving YCharts a try for free, visit ycharts.com using the link in our episode description or follow them on Twitter at YCharts.
All right, Brian. Now, one of the reasons that we aren't very worried is we've seen this transition play out before, and perhaps the most classic case of this is Microsoft.
When Satya Nadella, Microsoft's CEO, took over in 2014, he pushed the company away from a licensing model towards a software as a service model.
Now, if we look at Microsoft's revenue before this decision was made, we see that it does go up and to the right, and that's a good thing. But we also see that it was very lumpy. Again, that makes it hard for investors and for the company to know what's coming down the road.
This graph shows just how lumpy the company's year-over-year revenue growth rate was. In some years, Microsoft reported 30% growth in revenue. In other years, like 2009, it reported a 15% decline in revenue. That's because the vast majority of its revenue was pulled in through licensing deals.
Now, you can see that when Microsoft made the decision to transition from licensing to a software as a service model, revenue actually dipped precipitously.
That's because the company wasn't getting the upfront payments anymore, it was getting a much smoother stream of revenue due to its SaaS model.
So, what did that look like for Microsoft in real time as the transition was being made? The company went from revenue growth of 24% to revenue contraction of 12% in less than a year's time.
The good news is that short term pain has really paid off. Microsoft's revenue growth ever since the transition was completed has been much smoother up and to the right.
Also worth noting that that transition has worked out quite well for investors who have 6x their return in that time frame.
Another example of this transition paying off can be seen by looking at Adobe.
Now, before 2012, which is when Adobe started transitioning to a SaaS model, they had lumpy revenue. The dot-com crash eliminated a lot of demand from tech companies for their product. The Great Recession did the same thing, but that last dip is from when the company decided to forego licenses and focus on software as a service.
During that year, Adobe made the decision to transition its business model away from licensing towards its Adobe Creative Cloud, which is its software as a service product.
Now, you can see if you look closely that revenue did dip after that. However, it has continued to go up and to the right in a smooth curve ever since.
And investors have been hugely rewarded for hanging on to shares during this time, with the stock up more than 1,300%.
Now, it's worth pointing out this isn't limited to just Microsoft and Adobe. Atlassian, Autodesk, and Alteryx are all in the process of transitioning from a licensing model to a software as a service model.
So, how is the transition going at UiPath? Well, management recently gave investors an update.
UiPath calls their SaaS solution the UiPath Automation Cloud, and we can see that it's relatively new, only having been available for 27 months.
Despite the fact that this product is barely over 2 years old, it's already transitioned 15% of its annualized recurring revenue to this cloud product.
That's because it's proving very popular with customers, especially new customers. 38% of them are now using the Automation Cloud, and it's a fast growing part of the business.
So, as this transition continues to take hold, investors should expect that revenue from licensing will drop as a percentage of sales, and revenue from subscription will grow as a percentage of sales. The net result of that is going to be downward pressure on this year's revenue. However, that's short term pain that could pay off in the long term. Now, to be clear, there's no guarantees that this move will pay off for shareholders, but history is rife with recent examples of this transition paying off big time.
That's right, Brian. There's no way to know for sure how this will shake up for UiPath, but I think a couple of things for sure will happen. One, its revenue is going to get to be a lot more predictable. Two, I believe the moat will widen around the business. And three, I believe it introduces more optionality.
That's why UiPath's slowing growth in the near term could actually paint a brighter future for shareholders in the long term. Was this video helpful? If so, give us a thumbs up and let us know in the comments section below. Brian's out.